$32 billion. That is the number the crypto world used to brag about this empire. Now ask yourself a simple question. If your exchange promised safety, liquidity, and world-class controls, how could billions vanish almost overnight? Imagine opening your account and seeing zeros where your life savings once stood. Would you smell a bank run? Or would you suspect a deeper deception? Today we go inside the fall of FTX and we test one claim. Was this the most brazen and old-fashioned corporate fraud of the digital age, hiding in plain sight? Stay with me, because the next minute may change how you judge every pitch in finance. Picture polished ads and stadium naming rights that signaled trust. The story looked safe from the outside. It felt solid. Here is the setup. FTX began in 2019. It grew fast by offering crypto derivatives and easy access to complex bets. Behind it stood a young founder named Sam Bankman-Fried, a trader with a gift for marketing a mission. He promised efficient altruism and safer markets. In late January 2022, it announced a $400 million round. Reporters and investors wrote that the company now carried a valuation of $32 billion. That headline signaled blue-chip confidence. Major funds and even a teacher's pension plan joined the cap table. Meanwhile, the brand bought a stadium name and hired celebrities. The exchange split its empire into two fronts. FTX.com handled global customers. FTX United States pitched a safer walled garden for American users. Alameda Research sat nearby as an affiliated trading firm. It borrowed, lent, and made markets in the same universe of tokens that FTX listed. That structure demands strong conflict walls. A conflict wall is a hard rule that keeps a broker from tipping a favored trader. It also demands treasury discipline. Treasury discipline means customer deposits are held intact, never touched for bets or loans. Yet the culture signaled the opposite. Senior insiders used auto-deleting chats. Basic accounting ran through simple small business software. Board oversight was thin. Risk teams were light. Senior control concentrated in a tiny circle of loyal lieutenants. In the summer and fall of 2022, crypto markets were already hurting. Lenders failed, hedge funds blew up, liquidity dried up across the industry. In that climate, a single spark could trigger a run. On the 2nd of November 2022, a trade publication reported that Alameda's balance sheet leaned on the FTT token. That token was issued by FTX and tied to trading discounts. It was not cash. It was not a high-grade asset. Then a rival exchange announced that it would sell a large stash of FTT. The market heard the drumbeat. Withdrawals surged. A true test of reserves began. From the outside, you could mistake this for a liquidity crunch. From the inside, something more fatal was waiting. Stay with me, because the next act shows how a hidden drain can empty even the biggest pool. Here's how the scheme worked, step by step. Customers wired dollars and stablecoins to the exchange. They thought those assets sat in segregated accounts. Segregated means money cannot be touched for lending or speculative trades. Inside the group, the wall between the exchange and Alameda Research did not hold. Code and policy gave Alameda a special lane. On the exchange, normal users faced strict limits and auto-liquidation. Alameda, according to court filings, was spared from those liquidations. That exemption let Alameda keep losing positions alive. It let losses grow. At the same time, FTX issued a token called FTT. That token had a market price, but a thin market. A thin market means small trades can move the price a lot. Alameda held piles of FTT and used it as collateral. Collateral is the asset you pledge to borrow more money. By keeping FTT prices up, Alameda could show strong equity. Strong equity then supported more borrowing. This created a circular engine. The exchange listed the token. The affiliate held it. The affiliate borrowed against it. Meanwhile, customer deposits quietly flowed to Alameda. Those funds supported venture bets, political donations, luxury purchases, and risky loans. Some loans went to insiders, some loans patched short-term holes. Records were weak, messages auto-deleted. Accounting ran on basic tools, not robust systems. Investors and lenders received glowing assurances. Risk was described as controlled, but internal controls did not match the promises. Consider the classic term commingling. Commingling means mixing client assets with house assets. That is banned in regulated brokerages for a simple reason. It tempts misuse. The group was based in the Bahamas, which left a patchwork of oversight for an international business. American regulators could look at the United States affiliate, but the main pool of customer assets sat offshore. When crypto markets turned, Alameda needed cash to meet lender calls. Lender call means a demand to repay or post more collateral. Customer money became the convenience source. The flow was large. The flow lasted for months. Exchange dashboards still showed balances. Yet the real cash was gone or pledged elsewhere. That is why the run in the early November became fatal. Once withdrawals surged, the gap could not be hidden. To buy time, leadership tried to raise emergency money and to find a white knight buyer. A rival signed a letter of intent and then walked away after due diligence. Without the rival, the whole stared back. One more detail matters. The founder told the public that United States customers were safe, but later filings described a far wider shortfall across the group. In plainer words, the empire had been running on borrowed customer time. Every new deposit papered over yesterday's loss. These mechanics were not innovative finance. They were the same old blueprint of misuse, only faster and online. Public decks touted controls and risk limits. Stay with me, because the reveal shows exactly how the mask slipped in public, day by day. The mask slipped in early November 2022. A trade outlet published a balance sheet for Alameda that showed heavy reliance on the FTT token. Market makers read the signal. A major rival said it would sell its FTT holdings. The token price fell. Customers began to pull funds. The exchange slowed withdrawals. Anxiety turned to panic. The rival considered a rescue. A non-binding letter of intent appeared for a day. Then the rival walked away after reviewing the books. By the 9th of November, the website warned that withdrawals were not processing. The next day, the founder said the group needed outside capital. He said he was sorry. On the 11th of November, the main exchange, the United States affiliate, Alameda, and over 100 related entities filed for bankruptcy. Sam Bankman-Fried resigned. A veteran turnaround chief named John J. Ray III took over. In court filings and testimony, he described a complete failure of corporate controls. Investigators in the United States opened probes. Within weeks, American agencies filed complaints that described a years-long misuse of customer funds. Executives from inside the group pleaded guilty and agreed to cooperate. The criminal case went to trial in October 2023. In early November, the jury returned guilty verdicts on 7 counts. In late March 2024, a federal judge sentenced the founder to 25 years in prison. The Justice Department said he took customer money, defrauded lenders, and lied to investors. At the same time, the bankruptcy team traced and sold assets to build a recovery pool. Rising crypto prices and stakes in a high-growth artificial intelligence company added billions to estate. In the spring of 2024, the debtors filed a plan that forecast full payment to most creditors. Under the law, the plan later won key approvals. Yes, that is the twist. Customers may receive their allowed claim value in cash. Still, many will note that their coins were worth much more before the crash. Stay with me, because the last chapters show how the fallout changed regulators, auditors, and investors around the world. The collapse sent shockwaves through finance and culture. Venture stakes went to zero. Stadium signs came down. Class actions hit celebrity promoters. Some have settled pending court approval. Regulators moved fast. United States civil agencies filed sweeping complaints. Prosecutors won convictions on 7 counts. In March 2024, the judge imposed a term of 25 years. The founder has appealed to the Second Circuit. The bankruptcy estate chased clawbacks to refill the pot. An audit firm tied to the group later settled with the Securities and Exchange Commission over poor audits and independence lapses. Liquidators in the Bahamas and the United States coordinated under a global deal to align recoveries. In May 2024, the debtors filed a plan to pay most customers in full, based on allowed claims in dollars. Asset sales, litigation wins, and rising crypto prices supported that forecast. Yet there is a catch. Claims are priced at the petition date, not at later highs. So a holder who watched prices rebound may feel shortchanged. The cleanup will take years through appeals, distributions, and objections. Regulators in the United Kingdom tightened rules on promotions. United States agencies stepped up investor protection for digital assets. Civil regulator pursued parallel cases. Here's the cliffhanger. Can better rules and tougher audits stop the next copycat? Your defense starts, your checklist starts now. Treat every platform like an unregulated broker until it proves otherwise. Ask if customer assets are segregated at a licensed trust or bank. Ask who audits the firm and whether the audit is truly independent. Proof of reserves without proof of liabilities is theater. Demand both. Avoid native tokens as collateral. That is circular risk. Prefer platforms with cold storage and public attestations. Use a hardware wallet for long-term funds. Spread risk across venues and keep leverage low. Read how claims are valued in bankruptcy. If the marketing dazzles and controls are vague, walk away. If you want more investigations like this, subscribe to Money Mystery and share this video. Comment the next case you want exposed. Stay skeptical.